Hey everyone, welcome back to the Retail Compass. So I want to give quite an urgent market update because something big happened last Friday. Last Friday, Donald Trump tweeted that the US would impose 100% tariffs on China and new export controls starting 1st November as Beijing restricts rare earth exports. This is a direct escalation in the trade narrative, and the S&P sold off close to 3% and the Nasdaq fell even more. So this marks the first significant sell-off since the Liberation Day volatility earlier this year. Many of you guys probably already forgot what it's like to see such a big red day. So I made this video quite urgently because I think it's important, given people have been waiting for a dip for so long to maybe deploy their lump sum investments, and they are probably asking, is it the time now? So this video will lay out some facts to try and help you make an informed decision. And before I begin, if you don't want to miss urgent market updates like this one, especially when big catalysts happen, do make sure you hit the subscribe button so you can stay ahead of the narrative, not behind it. So let's dive in. Firstly, why is this news market moving? Reason is because you probably can't even recall, the last time you heard people talk about tariffs. Markets have largely discounted this risk, and that's precisely why it had the power to shock investors. So I mentioned in my previous video that you should ignore all the various talking heads and so-called gurus who's trying to predict an AI bubble. Because if so many people are looking at it, waiting for the crack just won't come from there. It will come from somewhere else. And now, here we have it, potentially. So just like that, we got our first real question in quite a while. Should you buy this dip? And again, we're not talking about, dollar cost averaging investing. We already established earlier on why structurally equities will go higher in our earlier video. So you should continue doing DCA if you have been doing that. But this is more about deploying lump sum investments during market sell-offs. So this is not going to be another blindly optimistic video or a fear-mongering video. We are going to look at the facts. Let's take the emotions out of it, look at the facts, the actual positioning, flows, and probability. So first, let's look at how big money institutional investors are positioned. Right now, hedge fund gross leverage, as you can see, sits around 300%, and net leverage is also close to all-time high. And after such a period of market rally, asset managers in general are all pretty heavily long in equities. So if I were to give you an estimate, maybe I would say they are roughly 8 out of 10 on a historical scale. So while, they still have some money and dry powder lying on the side, it's not much. And do you think they will rush in to buy with just a 3% dip from all-time highs? Right? Just ask yourself, if you have, say, $10,000 of net worth, and you already have $8,000 invested in stocks, would you really throw in your last two, on the first day of a dip? Probably not. Things will probably be very different, of course, if you only had 2,000 instead of 8,000 invested. In that case, you would likely be at least investing some of your remaining 8 in case the market really rebounded. But right now, you wait for more clarity. And that's exactly what these discretionary, institutional investors are doing now. They are pretty near full allocation, and there's still little dry powder left, but that's not enough to stop a wave of de-risking if sentiment turns. Now, let's continue to look at the other group of market moving players, the systematic quant players, right? There's mainly two big groups of these. I would say first, the quant trend following investors, as well as the volatility control funds. So trend following is straightforward. If trend is up, then they will be long, and if trend is down, then they will be short. And volatility control funds basically means if you think about it, the VIX is low, they are able to take more risk, they are able to go more long. But once the volatility spikes, then they will have to cut exposure. So these guys have been almost close to max long for weeks. They have been riding the uptrend and the calm volatility environment. But if this sell-off continues and the uptrend turns into downtrend, and the VIX, look at the VIX, is already creeping up, it's already starting to spike. If it continues, these same guys who have been long equities for weeks could cut exposure and even flip to short. So this kind of shift can magnify short-term drawdowns, not because the AI story really changed, but because the flows changed. The sellers simply are going to overwhelm the buyers in the short term. So next, let's look at upcoming events and catalysts. So corporate buyback programs are largely in blackout until October 24th. What does that mean? So from now to October 24th, corporates are not allowed to buy back their own shares because they are going to announce Q3 earnings soon. And corporate buybacks has been one of the market's biggest natural buyers so far. And these guys will be temporarily sidelined for close to the next 2 weeks. And then we look at the Trump-Xi summit. This was scheduled for November 1st. But between now and then, there are roughly 2 weeks. And market's going to be waiting, to see what happens at the summit. And before that, there's just no clear positive catalyst, right? So some people may say, yes, earnings season, if companies deliver strong earnings, maybe it could eventually stabilize things. Well, I don't disagree, but we have to get there first. And 2 weeks is a long time in the market if we were actually to get a sell-off. Just remember what we saw during Liberation Day over that few days. But with all that being said, of course, anything can happen. Trump and Xi could walk back their restrictions, China could ease their tone, markets could rebound sharply. That's always possible. But if you are in the business of investing, you don't want to deal with certainties, because markets are uncertain. You only want to look at the probabilities. And right now, the probability skew is tilted definitely towards further near-term downside. That doesn't mean an all-out crash. It just means that the risk-reward for retails for us to buy the dip isn't attractive yet. So the short answer to should you buy this dip? Yes, eventually, but not yet. There's no rush, right? If you recall what happened during Liberation Day, what we should do now is to wait for the forced sellers to clear out, wait for institutions to do their necessary risk adjustments, and wait for volatility to reset. And that's when the opportunity truly begins and we can go back into a normal uptrend. I will try to keep you guys, updated if I do see that things are turning back to normal and if the uptrend resumes. So that's all for this video. If you found this breakdown helpful, please take a moment to like this video and subscribe. It really means a lot to me. If you don't like it, you can always unsubscribe later on, and it helps me, to keep bringing you guys clear, data-driven insights that cuts through the noise that is honestly everywhere these days. Well, that's all. Thanks for watching. Invest safe, and I'll see you in the next one.